everyone, Jessica Morales joining you now with Justin Carlson, who's the Vice President and Managing Director for Research at East Daley Capital Advisors. Thanks for joining us, Justin.
Yeah, thanks for having me.
Absolutely. Let's start off talking about the market for Marcellus gas. What is the future market?
The market's the Gulf. I mean, the Marcellus gas has to get down to the Gulf. Yes, there are lines that carry Rover, Nexus, and certainly within the Northeast market itself. But the bulk of it, the majority, the growth, the growth profile has to go to the Gulf. Certainly now, but also as you think about the future, a lot of the future growth that the Marcellus wants to achieve, some of the objectives that producers have up there and would like to achieve, it has to go to the Gulf.
And next, if you can talk to me about the next wave of infrastructure, it's expected to come online over the next couple of years. What do you think that means for gas prices overall?
Well, it's a complicated question, right? So you talk about gas prices, but there's so much interplay between what happens in other markets. So when I see all of that gas, and there's 9.6 BCF of new capacity coming online before 2019, that's going to bring all of that gas supply down to the Gulf. The issue with that is that's also the most lucrative market. So all of those pipes should fill, and the producers have a huge financial incentive, meaning they've paid take or pay contracts, which they have to pay for whether they move the molecule or not. It's on their balance sheets. So they're going to have a high incentive to move it down, which means they're going to fill that capacity. The other piece of that is that capacity that goes to other markets other than the Gulf is competing with the rest of the country. So that's where it gets a little complicated, because what you could see is that initially you see improved basis, everything looks good, everyone's very happy. But as that production starts to grow, you fill that capacity very quick, especially since any capacity not going to the Gulf is competing with other supplies. So then there's an incentive to push it to the Gulf, which fills that that incremental capacity, or allows producers who own that capacity to resell it to somebody else, grab those molecules. That all of a sudden fills those pipes, and now you're constrained again. And so then you could see a situation where basis prices in the Northeast ultimately stay or get weaker pretty quickly, because again, the market for that is in the Gulf.
And what about takeaway capacity issues that you may see?
For gas, takeaway capacity, again, I think it will fill up. You could see pipes open. So the misleading part of this is that there will be other pipes that are empty. Pipes to the Gulf will be full. So when you look at it on a macro scale, you'll say, well, why aren't prices better? We have open capacity out of Dominion, out of Ohio. Why aren't they better? And it's because, well, you filled all the capacity down to the market. And when you think about sort of the squishiness of the gas market, where molecules can push other molecules out, well, the remaining molecules in the Marcellus that aren't going to the Gulf are fighting with the Permian, they're fighting with the DJ, they're fighting with Canada, they're fighting with every other basin that also doesn't have more capacity into the Gulf.
What about really how long, if you look ahead, I guess, how long do you think, Justin, it'll be before we see production growth and infrastructure develop and the balance out there?
Well, maybe, I hope never, right? I mean, as a market, we want to continue to grow. We want to continue to produce. Producers want to produce, and this is going to be a cycle that continues to happen, forever if we continue to develop our resources until again, at some point, you probably do see renewables take a bigger foothold, and that starts to temper back, and then you do have a leveling out of let's say production growth, and then opening up of capacity and things. But I think that's a ways off for us still, in order to have a significant impact on what we have. So I think you're going to need more capacity from the Marcellus, and it may not come until, let's say, the second wave of LNG, which is more slated towards like the 2023 timeframe. But that again, that first wave probably is not enough, and that we're going to need more capacity, and we're going to need more demand, certainly.
What's the buzz that you hear around the Marcellus Utica right now? Whether it's optimism or just that overall look at it.
Well, you sort of heard it at Doug East, with respect to, and this is where I always find the discussion about break evens and IRRs a little bit funny, because every producer in there is doing things better, faster, bigger, faster, stronger, or whatever. Everything's better, and we're going to optimize. And so, I think there is a lot of optimism. They see the capacity coming online. Again, I think temporarily that will help. But B, they continue to get better at what they do, and that's sort of the beauty of the model that we have here as a as a U.S. from a U.S. perspective, from a resource-based perspective, is the ability to optimize what you have, and ultimately the drive to be better at what you do. And producers have really exemplified that over the last decade or so.
Well, we appreciate your time, Justin. Thank you.
Yeah, thanks for having me. Appreciate it.
You're very welcome.
Yeah.
And for Heart Energy, I'm Jessica Morales.
To stay up to date on the most recent Heart Energy videos, subscribe to our YouTube channel by clicking here.